I have been asked by a couple of people recently to cover what the accounting and tax implications are of using cryptocurrencies in your business in Ireland. So that's going to be the purpose of this video. I'm going to cover off a couple of different things that you should be aware of. I suppose it's kind of relevant for a lot of people who are using the likes of Revolut to do their business banking. As you'll probably know already, Revolut Business Banking, they have a section in your business banking app where you can actually swap your business cash into cryptocurrency. While that may not be advisable in terms of volatility with your business cash and most responsible thing to do, I'm sure there's people out there that are doing it to a small degree. So I said I would cover it off in a video. Firstly, Revenue do have some guidance which I want to go through first. You'll be able to find this here if you Google the taxation of crypto assets, part 020103. You'll find it quite easily. So I'm going to cover off some of the key points in this document that you should be aware of. Firstly, the one I want to cover off here is, while cryptocurrency may be referred to as a currency by many people, in Revenue's eyes, it's best referred to as an asset. So that's really important when it comes to things such as capital gains tax. The next most vital section that we need to cover here is the direct tax treatment, particularly your corporation tax or your income tax. What I really want to focus in on here is this point here. For any business who accepts, say, a payment for goods or services in cryptocurrency, there's no real change in effect to how you actually account for that and how you pay tax on those profits. So let me just explain that a little bit further with just a very simple example. If we take company ABC Limited, they currently have stock worth €20,000, which they would expect to retail at €40,000 when they eventually sell it. They also accept Bitcoin as a form of payment. And on the 31st of January 2024, customer XYZ came in there and they decided they wanted to buy all of that stock and they would pay one Bitcoin, which at the time was an equivalent of €40,000. If we now think about the profit and loss account of ABC Limited on that particular date, this is how things would look. So they'd have sales of €40,000, which was the equivalent euro value of the one Bitcoin that they received on that date. They'd have your cost of sales of €20,000, which would have moved from your inventory on your balance sheet now into your cost of sales. And you'd also have a gross profit then of €20,000. Now they may have some other overheads, etc., and they'd work their way down to a profit before tax. And then, as usual, they'd pay their 12.5% corporation tax when they go to do their corporation tax return on their set of accounts each year. So everything in that respect is all the same. It's just you need to keep proper records of the euro value of that Bitcoin when you do transact in it, because this needs to be reported on in your financial accounts every year, and you need to have the right values here in your accounts. Now, if we come back to the revenue guidance here, the next point that I really wanted to focus on here was that Revenue really don't have any special tax rules when it comes to crypto asset transactions. You could really apply the same principles that you are already applying to your business when it comes to crypto assets. If you're using it for transactions, the same kind of rules basically apply. The only real kind of difference you could say is when it comes to capital gains tax. So that's the next point I really wanted to cover here. Obviously, when you start transacting in the likes of Bitcoin, you're eventually going to have to hold some Bitcoin on your balance sheet. Your company is going to be holding on to certain amounts of cryptocurrencies. Well, eventually what might happen is you might decide to sell some of that cryptocurrency and transfer it back into euro, for example. And anytime that happens, it is most likely going to be a disposal for CGT purposes. Unless you are an actual cryptocurrency exchange. In that case, your whole business would be trading and dealing in cryptocurrency, but in most cases, that's not going to be your business. So in any case there, you're going to pay capital gains tax on any profits that you make on that Bitcoin. So I'm going to further go through my simple example here just to explain that a little bit more. Essentially what that means is if you have some stock and you sell it for a certain amount of Bitcoin, you'll have that Bitcoin valued on your balance sheet at that transaction date, whatever the euro equivalent was. And let's say in a few weeks, the price may go up or down. And in the future, if you decide that you want to exchange that Bitcoin back into euro, you're going to have to calculate whether there has been a capital gain there between the price that you actually received Bitcoin at and the price that you're now transferring it back to euro at. And that would be going through your corporation tax return as normal, and you would be paying 33% capital gains on that. When it then comes to accounting for cryptocurrencies, there is also some guidance here that I just wanted to show you briefly from the ACCA. I'm just going to show you the stuff that you need to be aware of. I'm not going to go through this all in detail, but I'll leave a link below to this article down in the description section if you want to read it in more detail. So let's have a look at what they're saying here. So they're saying here that cryptocurrency has been subject to major variation in value, and therefore it's non-monetary in nature. Cryptocurrencies are a form of digital money and do not have physical substance. Therefore, the most appropriate classification is an intangible asset. So when we are doing our actual financial accounts, we'll be looking at it as an intangible asset. And so the international accounting standard there is IAS 38. There's two different ways that you can measure your intangible assets on the balance sheet, and they are at cost or else at revaluation. Using the cost model, intangible assets are measured at cost on initial recognition and are subsequently measured at cost less accumulated amortization. So if you go with the cost model, you'll need to start amortizing the cost of that Bitcoin or whatever cryptocurrency you have over a number of years, up to a maximum of 10. But it probably makes a lot more sense to go with the revaluation model. If you use the revaluation model, you'll be carrying the value of that cryptocurrency at its market value on your balance sheet. So you'll initially recognize the cost of that Bitcoin or whatever on your balance sheet, and then you'll constantly revalue it. And I'm going to show you just another simple example of the accounting on that, just so you can see it in practice. It's actually fairly straightforward. You just need to see a bit of a practical example just to get your head around it. So now I'm just coming back to our example here again, ABC Limited. So as I was saying here, they had received one Bitcoin, which was worth 40,000 euro for some stock. So now on their balance sheet, on the 31st of January 2024, they'll have an intangible asset. They decided that they were going to start using their revaluation model under FRS 102. Let's say, for example, 2 months have passed, and in those 2 months, up to the 31st of March 2024, the price of Bitcoin actually rises from 40,000 euro up to 60,000 euro. How would you reflect that movement in your accounting on your balance sheet? Well, this is how it would work. Firstly, your intangible asset will now increase from 40,000 euro to 60,000 euro, and you will also need to reflect that increase in the equity section of your balance sheet under accumulated other comprehensive income. So you'll be debiting your intangible asset by 20,000 euro and crediting your AOCI by 20,000 euro. So it's relatively straightforward. You'll just track the movement and kind of remark it every so often when you do your management accounts, and just make sure you get it right at your financial year end. And let's say if we further take this example on again, they decided now that the price of Bitcoin, it's actually looking pretty good at this price of 60,000 euro. They might go to cash in on it and transfer that one Bitcoin back to euro. So if that business decided to do that, they will end up increasing their cash obviously by 60,000 euro, so debiting their cash. They'll reduce their intangible asset. They don't hold any Bitcoin anymore, so they'll credit their intangible asset by 60,000 euro. They would also need to reduce this unrealized gain that they had reflected in their AOCI. So I'll be debiting my AOCI there for another 20,000 euro. And then I would be crediting my profit and loss account. So we made a profit on the sale of that Bitcoin to euro of 20,000 euro. We got it at 40,000 euro. We sold it at 60. We made the profit of 20,000 euro. We can reflect that in our profit and loss account as a profit on intangible assets of 20,000 euro. And essentially this is how our accounts look now. On our balance sheet, we just have 60,000 euro worth of cash. On our income statement, in addition to the sales and cost of sales and the gross profit, which I showed you earlier on, we'll also have a profit on the sale of intangible assets of 20,000 euro. And when you go and do your corporation tax return, this will need to be added back basically, and actually will need to be taxed separately under the capital gains section of your corporation tax return, and it will be taxed at 33%. So in this instance, this company is going to pay 6,666 euro of capital gains tax on the profit that they made on the transfer of their Bitcoin back to euro. So I hope that made some bit of sense. I know that was all pretty much at a very high level, but just to give you a bit of an overview, if you were thinking of dabbling a little bit of company money into cryptocurrency. It seems like a very risky thing to do, especially for a business. But you never know. There might be some legitimate reasons for doing it. So this is kind of things that you need to be aware of from a tax and accounting point of view.